Hi, I'm Trevor Kennedy. I'm a partner at Logan, Katz, Chartered Professional Accountants. We are a full-service accounting firm located in Ottawa. We have a second office in Toronto. We are a proud sponsor and supporter of the LSpark Accelerator program. Today, I'm here to talk to you about the wonderful world of SHRED, Scientific Research and Experimental Development. The SHRED program is an investment tax credit program administered by the Canada Revenue Agency, accessed by filing your corporate tax return. Individuals and partnerships can also gain access to a SHRED claim. However, I'm going to focus on Ontario-based corporation. Countrywide, the various provinces all have their own individual SHRED programs. The technological qualifier relies at the federal level. The form is the T661 part of your corporate tax return. Once you qualify for the federal claim, the provincial claims all piggyback, and there's just various investment tax credits. Province to province, the rates do vary slightly. There are other nuances as well, so I'll focus on Ontario-based filer. SHRED overall is incentivizing Canadian corporations to conduct qualified research and development within Canada, thereby giving them a competitive edge, allowing these companies to scale, which will generate taxable income. Companies will pay corporate taxes, will hire a skilled workforce who will be paid at a healthy salary rate, which will then individually pay their high personal taxes. In order to do this, the CRA has come up with a very lucrative investment tax credit. A Canadian-controlled private corporation, a CCPC that's filing a SHRED claim, can earn up to 65% of the salaries spent on a qualified project, of which 60% is fully refundable. What that means is in those early years when your company's in the startup phase, you're burning through cash, you're investing in your R&D, investing in your team, you can file your corporate tax return with a loss, and the CRA will generate a refund of 60% of the salaries spent on SHRED. The remaining 5% is a non-refundable tax credit, which means that 5% will carry forward and can be used to offset future Ontario corporate taxes. Subcontractor costs and materials also qualify for SHRED, but at a lower rate. The reason being, one, the incentive, the purpose is to create a workforce paying high taxes, thereby giving more money to employees. The calculation works out, it's because there's an overhead allocation, a proxy allocation, based on the salary levels. Now, I referenced the Canadian-controlled private corporation. Non-CCPCs also qualify for SHRED, but the rates are lower and more weighted to non-refundable tax credits. High-level recap, a CCPC can earn 65% total tax credits, of which 60% is refundable. A non-CCPC, the rate is 38%, of which only 12% is refundable. Very big difference when you're looking CCPC versus non-CCPC. The question of what is a SHRED claim, if we focus on the technical side, the company has to be conducting qualified research where you are expanding general knowledge or focusing on a technological obstacle that you're trying to overcome. There is a burden of documentation on the taxpayer to maintain records, to be able to show whether it's a time allocation. So if you're dealing with employees, you want to be able to allocate 60% for SHRED, 40% for non-SHRED. You need a way of showing that back up. Diagrams, meeting minutes. So the burden of proof lies on the taxpayer. I like to explain to my clients, think of it as an elementary school science project. You outline what is your overall hypothesis. Here's my approach, my results and conclusions. If there's failures, that can even further argument that you have a SHRED program because you had an approach to solve a problem, it didn't work, so you had to either pivot or change and continue, spend more resources. So failures in the world of SHRED is actually a good thing. If you have any questions or need any assistance, please do not hesitate to reach out. Thank you.